Hey, hi, good morning to all. Welcome to today's daily dose of market insights brought to you by OANDA, presented by myself, the senior market analyst of OANDA Asia Pacific, Kelvin Wong. So before we start today's session, today will be the Wednesday, 20th of September. So now let's take a look at the disclaimer slides first. All right. Okay, so leverage trading is risky. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product. All right, so as usual, this will be our three key, we call it pointers or agenda for our daily market insights, our daily dose of market insights, which will be the highlight of key events in terms of market moving news or economic data release that took shape yesterday, and as well as earlier today's Asia session, and also most importantly, what to watch out for in the next couple of hours for today, especially on key economic events or corporate events. And lastly, we'll be covering what I call short-term technical outlook on the various asset classes that I found it pretty much interesting that I would like to share with you all. All right, so without further ado, let's look at what happened last night. Okay, so if you look at yesterday's performance of the US stock market, so the performance of US stock market was rather weak at the opening. So what we could see over here is that the Dow Jones, the S&P 500, the Russell 2000, as well as the Nasdaq 100, all fall at the opening. And the worst hit was the Nasdaq 100. So within a couple of the first three, pardon me, the first 3 hours of the US session, the Nasdaq 100 almost tumbled close to negative 1%. But however, towards the end of the closing session, all these indices managed to recoup a bit of their losses. So ended less rate, I would say, in terms of the magnitude of losses. So the Dow Jones and the S&P closed at negative 0.2 to negative 0.2 to negative 0.3%. So the worst hit was the Russell 2000 at negative 0.4%. So let's take a look at the performance of the S&P. So what we could see is a kind of a volatile session. Yesterday, plunged down pretty much in a rate. Then thereafter, it managed to actually recoup a bit of losses to close near the opening price or near the opening level towards the end of the session, but still ended negative right ahead of a key event that's going to take place today. So later I'll show you what is the key event to look out for. Right, so now let's take a look at the performance of the S&P 500 heat map here, so that you all could have a better picture of the performance of the US stock market last night. All right, so now let me focus more on the screen. I'm hiding the camera. So what I could see over here is that the mega cap stock actually reduced their losses. So Apple actually managed to be positive at 0.62%, but Nvidia still closed in the red at negative 1%. Then you have Meta up 0.8%, unchanged for Google, Alphabet, Tesla positive 0.5%, Amazon negative 1.7%, almost unchanged on the Microsoft, a bit of minor loss or minute loss and negative 0.13%. So all in all, what I could see is that it's a rather mixed picture on the market leaders, which is the mega cap stocks. So that actually causes, if you look at the performance of the S&P yesterday, is at a negative 0.2%, then almost the same as Nasdaq, negative 0.2. The worst hit was still the Russell 2000, negative 0.4%. So what I could see that over here, right, market are still a bit jittery. No clear signs of a what I call short-term bullish reversal yet. So later I'll share you the chart, the individual chart of the short-term technical outlook of the Nasdaq 100 and the Dow Jones Industrial Average. So with that, now let's take a look at what happened overnight in terms of the key event. So key event, what happened overnight over here was this CPI data for Canada. So still recall that Canada itself, yesterday we do have a short-term technical outlook on the dollar CAD to be a bearish bias. So dollar CAD bearish bias actually hit that short-term support level that we actually highlighted. So also primarily doing reinforced by this news coming out for the Canada, where inflation rate actually tick up slightly above expectation. So that means they actually support the Canada dollar against the dollar CAD, against the dollar. So that's why the US/CHD actually plummeted right into our short-term support that we highlighted yesterday. So what we could see the inflation rate for Canada, 4% for the month of August, slightly above consensus at 3.8%. So if you look at the trend of the inflation, it starts to actually tick upwards over here. So this current one for August is the highest reading in the last 3 months. So potentially, right, what I could see is that is the impact of higher oil prices that was actually seen 2 months ago that rallied by 20%. So all in all, right, what we could see right now is a lot of global economy right now is facing the risk of stagflation. That means very sticky, elevated inflation level that is causing by the supply side of the oil market. Why? Because the Saudi and Russia, they're actually uh, we call it tightening supply, especially the OPEC plus country from the Saudi side of the story. They're actually tightening their supply. So then do not forget, right now we are coming to the seasonal demand closer to autumn and winter for the European economy, where they actually much needed more of oil and gas. So with the tighter supply over here and with seasonal demand coming in, that actually causes oil prices to actually to actually have this spiral, we call it positive feedback loop for oil prices to go up higher and higher. So that could actually impact core inflation data we highlighted earlier. We start to creep up already, okay, by the August figure. So if you look at, even though the non-core, right, if I exclude oil and energy, exclude food and energy for Canada, if you look at the non-core situation over here, also starts to tick up 3.3%. Okay, start to tick up slightly higher as well. So something to be aware of is that this stagflation risk is pretty much we call it creeping up, or the risk of it creeping up to the global economy is getting higher as if oil prices continue to increase in the following months. All right, so this is something to be aware of, especially if you are looking from a medium term to a longer term perspective of the markets. All right, so now let me reduce this. Okay, so now what's happened next, what happened earlier during the Asia session for today, Wednesday, is we have China. So China, with our expectation, the loan prime rate one of the key benchmark interest rate for China, they didn't change, still maintained at 3.45% and 4.2%. So the reason why is that because the PBOC, the China Central Bank, they cannot actually cut interest rate, direct cut of the interest rate too much. Why? Because that could actually impact the CNH, the offshore yuan, to weaken much steeper against the dollar. So once that happens, there's a negative feedback loop into the stock market, the China stock market. There's a risk of higher capital flight away from Hong Kong and away from China, which eventually will increase the risk of deflation in China. So for the China policymakers, their hands are pretty much tied because they cannot do what the Fed and the other central banker did by to cut interest rate close to 1% or close to 0% to actually pump up their economy. Okay, so their hands are pretty tight. So the China policymaker opt to actually reduce the bank required reserve, the RRR, last week. So it's a kind of an indirect, we call it increase of liquidity into the China monetary system, China financial system, via a direct cut of the interest rate. So now I'll share with you the dollar CNH chart, which is still pretty much we in sideways range. So due to this policy, earlier loan prime rate remains unchanged. So that gives a bit of support of the last 3 months or 4 months of Chinese yuan weakness against the dollar. So what's coming up next, right, will be the inflation rate in UK, which is out at 2 p.m. Singapore time later today. And most importantly over here is later Wednesday or Thursday, Singapore time to be precise, is the all-important Fed FOMC meetings. So this interest rate decision is more or less been baked into the market unchanged, no cut. But what's interesting in the market is the projection, the economic projection that's going to be released at the same time at 2 a.m. and also at 2:30 p.m. This is where Fed Powell press conference, where market will actually try to market will get a hint on what is the current guardians of the Fed thinking in the current state of the economic situation, especially right now with oil prices going to actually oil prices inching up much higher. Will the Fed be pretty much concerned about this elevated inflation due to oil prices, and how are they going to cope these oil prices? Do they want to keep interest rate higher for longer? Why? Because they could actually offset higher oil prices from a weaker demand. So if interest rates are kept higher for longer, it will actually, number one, reduce consumer we call it sentiment and business sentiment. Why? Because of a tighter liquidity condition. Lending conditions are pretty much tighter. uh, then company may start to actually we call it reduce we call it wages in the fact that to actually counter this indirect higher costs. All right, so all in all, right, will the Fed take this step to actually weaker consumer demand or business demand via keeping interest rate higher for longer to counter this elevated inflationary pressure driven by the supply side crunch on the oil market? So to get a hint on that, they're going to hear the press conference as well as the economic projection. Okay, the dot plot projection. So now, before we talk about the dot plot projection, let's take a look at what market is priced in based on the interest rate futures. So this CME Fed Fund Watch 2. So if you look at it over here, is that for sure 99% is expecting unchanged on the Fed Fund rate, 5.25% to 5.5%. So think about it. If the Fed starts to actually hike this time around, for sure there will be a tremendous or a very high likelihood of a steep risk-off event in definitely the stock market. And most importantly, the dollar will actually rally pretty strongly as well across the board if the Fed will actually hike interest rate this time around, because market is not expecting a hike. Yeah, it's 99%, no hike, remain at 5.25% to 5.5%. So going forward, right, market is only expecting one more hike before 2023 ends. Is either in November or December. So if you look at the November FOMC meeting, so we have at least about a 28% chance of a hike to 5.5% to 5.75%. So that's actually dropped down by a fair bit from last week. So last week was 41%. All right. So if you look at the December one over here, also almost the same, slightly higher at 35%. All right. So that's also so if you look at it, what market is actually implying based on the interest rate futures, uh, one more hike either in December or November. So that's it. So the terminal rate this time around for the current hike cycle that started about 1.5 years ago will be at 5.5% to 5.75% for the for the Fed funds rate. Okay, so what's going to happen next, right? If I were to look at the accumulated probability of this table, okay, let me expand it so you could see it clearer. Okay, the total probability of the accumulator. So the one over here is one, it starts to ease. So the first cut market is expecting to come in, not high, the cut. So 5.5 to 5.75%, one more hike. Okay, that's the terminal rate. Then thereafter, next year, the cut will come in. So the first cut market expecting to come in is June to July at 49% to 67%. If I look at the east column over here, okay, can see. So now market is actually pricing the first cut to come in either June or July next year. Okay, so now the big problem over here is, what if the Fed now starts to change the expectation of inflation in the US economy? And also, how does the Fed view current inflation expectation right now? Is it going up or is it coming down? So now market is having a rather optimistic view that going forward next year, June or July, the first cut will come in. That means, i.e., somewhere around the early part of next year. So we talk about the first quarter, Q1 to early Q1 and Q1, inflation expectation and inflation should die off again. But now let's look at what is the market is price. Let's look at some economic data and market-based inflation expectation. Okay, so let me share with you this very interesting chart first about inflation expectation. We call it the break-even rate. That means what is this break-even rate? 5-year break-even rate in orange and blue is from today, what is the inflation rate 5 years from now and 10 years from now? And I correlate it with WTI crude oil price. So you realize that crude oil price has been going up higher and higher in the last 2 months. This break-even rate also inch up higher as well at 2.37% and 2.3%. Do not forget, the magic number is 2% for the Federal Reserve. So Powell said that he only be confident to actually start to actually perhaps thinking of monetary easing if inflation is back at the 2% level. So if oil prices going to go up much higher at 91 level right now, yesterday hit 91. So imagine it could be tighter, some expectation at price it to 100. So going forward, right, that means you're talking about Q1 and Q2 next year, the inflation expectation won't be staying at 2.3%. It tracks the oil prices. It will go up to higher above what we're seeing right now at 2.4 and 2.3. Maybe you got 2.5, 2.6 over here. So if this market scenario were to actually play out in the next 3 to 4 months, that means where we head into Q1 and Q2 next year, do you think that the market is being a bit optimistic over here at this point in time to actually price in an interest rate cut to come in June and July? Possibly, right? That means right now the market is a bit optimistic. Okay, so if the Fed were to actually be watching this set of data that are watching right now, they may not sound so confident that their job is being done later tonight Singapore time. All right. So now what's the dot plot is showing previously? This is a dot plot. So you want to find how to find a dot plot, just Google dot plot FOMC minutes, you're able to get this data. All right, it's free throughout the web. All right, or you could go to the Federal Reserve website and obtain it as well. All right, so this was the dot plot that they released in the previous June meeting. Okay, so this time around, the meeting on tonight, they will release the latest dot plot. Why is it important? Because market will actually get the thinking of what the Federal Reserve officials are thinking. So if you look at the PCE inflation, at that point in time, when PCE is the favorite inflation gauge, so when they release right in June, they're expecting the core PCE inflation to come in at 3.9% at 2023, end of 2023. Then in 2024, they expect to slip down to 2.6%. All right. And also GDP, they're actually expecting 1%, an upgrade from 0.4% they projected in March. And also in 2024, they expect to have a GDP increase in US slightly above 1.1%. All right. So market will be placing close attention on their core PCE inflation. Do they want to stick at 2.6% or will it raise higher? Given the fact this was in March, March at that point in time, oil prices is only about 70 plus per barrel. All right. So now it's really jumped about 20%, more than 20% increase since March. All right. So do they still will be keeping 2.6% for core PCE inflation and core PCE due to the higher oil prices? So market will be looking at this number. So if this PCE data has starts to increase for more than 2.6%, and especially when you're talking about the change in real GDP, they managed to actually inch down lower to, let's say, 1% for today. That actually implies a kind of a stagflation scenario. That means elevated inflation with risk of a slowdown in economic growth as well. So that actually doesn't bode well for stock or risk assets, but that will be a big mix for the dollar, because dollar, we need to look into isolation of, we cannot look at isolation of the Fed, we need to look into comparative to other central bank policy as well. All right, so now let's start off with the FX market short-term technical outlook first. Okay, now let's take a look at very quickly the performance of the FX market as a whole. So this is the 1 month performance, okay, the rolling 1 month performance as of today, Asia session right now. So we could see over here is that the dollar is still strengthening against the European currency, the sterling, the euro, and the Swiss. A bit mixed on, also try to creep up against the dollar yen, but against the rest of the China proxy, the CNH, dollar is pretty much going like sideways or neither here nor there, but it's not as strong as the European currency. So you can see that CNH is tracking pretty much closely against the Kiwi, in line with the Aussie. Then dollar CAD itself was actually due to we call it higher oil prices that actually saw the dollar sold off against the Canada yesterday, and also reinforced by a what I call stronger or slightly uptick in Canada inflation number. All right. Okay, so if you look at the 5-day performance, rolling 5-day performance, more shorter term, this is much more pretty obvious over here. Okay, the stark difference between this point in time. All right, the CAD, the Aussie, and as well as the Kiwi. All right, so now let's take a look at the short-term technical outlook for the euro and the sterling first. Okay, so let me start off with the euro dollar. So for the euro dollar, right, yesterday it actually tested 1.0707 key short-term pivotal resistance before it backed down. So in this 1.0707 short-term pivotal resistance is pretty crucial to maintain our short-term bearish bias on the euro dollar for it to actually at least had a minor setback to retest last Friday swing low at minus swing low at 1.0635. All right, for this level, a break below it potentially expose the next short-term support at 1.0585. However, if we start to see a clearance or hourly close tonight later at 1.0707, then this short-term bearish bias will be invalidated to see a squeeze up to test the next resistance at 1.0770 on the euro dollar. Okay, then on the sterling dollar, so I could see on the sterling dollar over here is still faring pretty much bearish, still holding below the 200-day moving average. The hourly RSI has started to shape lower high over here, sloping downwards, and now inching back below the 50 level mark. So what you could see over here is that the sterling dollar bearish momentum still rather intact in the short term in terms of the technical analysis on the hourly chart. So we'll be still using the 124.60, which is slightly below the 200-day MA as my key short-term pivotal resistance to actually maintain this short-term bearish bias heading towards potentially the next short-term support at 123.40 level. So however, if we start to see a clearance and the hourly close above 124.60, then this short-term bearish bias will be invalidated to see a squeeze up towards the next resistance level at 125.50 on the sterling dollar. So now what's next for the dollar CAD? So dollar CAD, if those who joined the call yesterday we have the short-term support level at 134.45. So it peaked down and test as expected and went down much lower towards 33.70. So what's 33.70 over here? So 33.70 over here is actually this congestion zone. Okay, this previous congestion zone over here that was formed in 9th of June and 10th of July this year, broken out, turns into a pullback support. So it stopped over here at this level. So what we could see over here is we start to see a very drastic puke down where the RSI hit a kind of an extreme oversold, and right now this RSI has really exit from this extreme oversold level, and what we could see over here is potentially we could start to see a kind of a mean reversion counter trend rebound that is taking shape within this short-term downtrend or minor trend since since the start of this month, 8th of September. So we will be flipping to a bullish bias, holding above 133.70 on the dollar CAD to anticipate this potential counter trend rebound, given the fact that the RSI has really hit a extreme oversold level and it exit from this level and managed to actually stage a kind of a bullish breakup up, okay, from yesterday's we call it resistance level over here. So I'll be using 133.70 as my key short-term pivotal support level to potentially have this minor counter trend bullish scenario towards 135 figure level resistance, followed by 135.40, which is the former which is the minor swing high of 14th of September and 15th of September, and also close to the 220-day moving average, and as well as if we do the Fibo retracement of the current push down, it's close to 50%. All right. So, but however, if we start to see a breakdown below 133.70, then this minor short-term bullish counter trend scenario, will be invalidated to see a continuation of this downfall on the dollar CAD to test the next support at 133.20. All right, so that pretty much sum up for the FX space. So one of the FX space, one pair we can look at will be pretty much interesting. It's a cross pair. Before we go, is the Euro yen pair. So the Euro yen pair also kind of tests the 20-day moving average. This is the hourly chart, still trading within this downtrend channel on the Euro yen cross pair. The RSI also kind of pretty much lackluster as well, going to inch downwards. Okay, so no clear signs of what I call upside momentum creeping back into the Euro yen shorter term technical configuration. So I'll be using 158.55 as a key short term pivotal resistance, looking for Euro yen to retest this minor range support level that is in place since of 11th of September at 156.80. But however, if we start to see a breakup with an hourly close above 158.55, then this short-term bearish bias will be invalidated to see a squeeze up to retest the 31st of August swing high area at 159.80 on the Euro Swiss. All right, so with that, let's quickly go to the stock indices. So for stock indices over here, the Hong Kong 33 index or the Hang Seng index. So with that, still trading kind of a sideways range configuration over here at this point in time. So for that, no change. I'll be still using 17790 as a key short-term pivotal support. Looking for a minor push up towards 18,160 level on the Hong Kong 33 within this sideways range that is in place since 11th of September. However, we start to see a breakdown below 17,790, then potentially we could see a further slide to test the 21st of August swing low area at 17,570 for the Hong Kong 33 index. All right, so now going on to the German 30. So for the German 30, it's going to actually inch downwards within our expectation. So for today, I will actually have a tighter key short-term pivotal resistance at 15,780, looking to it to test the next support area at 15,570, which is pretty much key, which is the swing low of 30th of September, 8th of September, and as well as 25th of August, tested 3 times on the hourly chart and also close to the 200-day moving average. However, if we start to see a break up above 15,780, then we could see a squeeze up towards 15,870, which is close to the 50-day moving average, now acting as a resistance as well. All right, so still maintaining that bearish bias on the German 30 index with a tightened key short-term pivotal resistance at 15,780. Okay, now quickly to the major US stock indices. Let's start off with the US Wall Street 30, which is the Dow Jones. So the Dow Jones Industrial Average or the Wall Street 30 peeled down as expected, hit that short-term support level that we highlighted yesterday, 34,335. Now managed to actually shape a bounce. But right now during the Asia session, you realize that a bit of bearish bias starts to come in at this level here. Previously, support broke, turns into a pullback resistance. The RSI also intended to shape lower high and still below the 50-day, below the 50 level. So indicating to us that there is still downside momentum in play on the Wall Street 30 index. So I will have a tightened key short-term pivotal support for resistance for today. I don't want to tie it so tightly at this 33,540 level. So I will tighten it slightly higher at 34,760 as my key short-term pivotal resistance, looking for it to retest 34,335. A break below it exposes the next support level at 34,100. But however, if we start to see a breakup, clearance with an hourly close above 34,760, then this short-term bearish bias will be invalidated to see a squeeze up to retest the minor range top of 31st of August and 15th of September, acting as a resistance at 35,050 level. Okay, so now Nasdaq 100. Okay, so Nasdaq 100 going to inch down as expected and hit the short-term support level we highlighted yesterday at 15,850 before it rebound. So this rebound over here, the price action also managed to stall right at a former minor ascending channel support, now turns into a pullback resistance as well. We also right below the 20-day moving average. So I don't want to tie it so tight at this level at 15,260. So I give it a breathing space. Key short-term pivotal resistance, tighten it to 15,360 for today. So as long as 15,360 is not surpassed, we will maintain that short-term bearish bias to retest 15,085, break below it, exposes the next support at 14,915. However, if you start to see a clearance above 15,360, then this short-term bearish bias will be invalidated to test the minor range top resistance that is in place since of 4th September, which is now at 15,540. Okay, very quickly, commodities, oil prices. So oil prices, still recall that the start of this week, we have a short-term, we have a short-term bullish bias with a resistance at 93.80. So 93.80 almost hit, yes, last night. It printed a high of 93.05. Okay, almost hit. And what you see over here is that momentum starts to dissipate. Why? Because of this bearish divergence that's formed on the RSI. So we were actually flipping right now, potentially, right? This oil price right now could see a potential short-term corrective pullback given the fact that momentum has started to turn negative or bearish on the shorter term time frame on the hourly chart. So we'll be using 93.80 as my key short-term pivotal resistance level to look it to have this short-term bearish corrective pullback scenario to take shape. A break below 89.50 potentially could take us down lower towards the next support level at 83.30, which is also the minor ascending trend line support that I draw from 23rd of August, confluencing with the 20-day moving average. However, we start to see a clearance with a breakup above 93.80 with hourly close above 93.80, then you will see a continuation of this impulsive up move towards the next resistance level at 95.80, followed by 97.50 on the oil price. Okay, so very quickly, XAU gold spot still maintaining that bullish bias on the gold spot with 92.22 as a key short-term pivotal support level, which is a 200-day moving average, looking at potentially to come to test the next resistance at 1948. However, if we start to see a breakdown below 1922, then this short-term bullish bias will be invalidated to see a slide down again to retest this major ascending channel support at 1913. So still maintaining that short-term bullish bias on spot gold at 1922 key short-term pivotal support level. Okay. Right now, yep, so this is the key highlights of the cover for today. So today we extend a bit slightly later due to the fact of an all-important Federal Reserve FOMC meeting that is due later at 2 a.m. Singapore time today. So we have reached the 32-minute mark. So I'll end today's session. So with that, have a great day ahead, and we shall speak again tomorrow. Thank you.